I'm Howie Lim. This is Money Hacks by the Business Times.
So there are still opportunities in China.
In the case of China, I think China's valuations still looks pretty attractive.
China's economy showed stronger than expected growth in the first quarter, reaching 5.4% year-on-year, exceeding the forecasted 5.2%. This indicates a positive start to the year, with significant momentum. Does this mean the Trump tariff policies haven't had an effect and won't? Does it also mean China's still worth investing in? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And if you have feedback or an idea for a podcast episode, do get in touch, btpodcasts@sph.com.sg. And helping us out today, Raisah Rasid, Global Market Strategist at JP Morgan Asset Management, and Sean Teo, Trader at Saxo. At the time of recording this podcast in the middle of May, the US said they would lower tariffs from 145% to 30% on China, while China's retaliatory tariffs on US goods would drop to 10% from 125%. This is promising, but doesn't take away from the fact that the tariffs may have dealt a blow to Chinese markets already. Here's Raisah Rasid.
From a financial perspective, we've seen the Chinese equity market really go through the correction the last couple of weeks. But a macro perspective, that's a little bit more interesting, right? Because China has been going through this downturn due to property market, etc. But coming to this year, we did see some positive news. We did see the government support stepping up last year on the fiscal side, on the consumer side as well. But again, obviously, we're in uncharted territories now. So we don't know how things will evolve over time, but that's going to have a very, very strong knock-on impact if you're an exporter of goods from China to the rest of the world effectively. So this positive momentum we're seeing in China, that's going to stop a little bit over the next couple of months, even quarters, even years potentially. So what we're going to look out for is really fiscal policy coming through, any sort of support. We did have a Politburo meeting. The politicians in China really come together, discussing the path forward for growth. And this is really the first one since the tariff came into effect. They are very adamant on really putting forth that sort of support coming through on the domestic front. What we're expecting is that the macro environment, at least in China, could at least have some floor on it going forward. There was an acknowledgement during the Politburo meeting that, we have to do something to at least mitigate the impact on these tariffs. And, that is really supporting advanced technology, whether it's being self-sufficient in artificial intelligence. Artificial intelligence typically has been very associated to the US, right? And now we're talking about AI in China. So we are seeing moves in that direction and really kind of finding new growth areas when it comes to China, whether that is electric vehicles, renewables, etc. So there are still opportunities in China.
Sean Teo, who's a trader with Saxo, agrees with Raisah on the opportunities front in China and elsewhere too.
Definitely, I think the US itself would likely be quite challenging amidst all these tariffs and high interest rates, but there has still been quite a few bright spots in other parts of the world, so namely being China, India, and Germany. In the case of China, I think China's valuations still looks pretty attractive ever since the outperformance of the US market somewhere in the mid of 2022. Chinese markets actually didn't do as well, but Chinese stocks valuation still looks pretty attractive as long as the government still continues to look for ways to stimulate the economy. Investors who are looking at the Chinese markets still can benefit from here. India also, I think, has been doing relatively well for the past couple of years. There were certain points in time that India was actually outperforming the US side. So this is actually due to overall country trade policies that India has been supporting the local businesses and also enhance their export competitiveness. So India is also looking to implement free trade agreements with the European countries. So this will help the Indian economy to further prosper from here. And lastly, Germany, a little bit similar to the Chinese market. Valuations are also still more attractive as to the US is looking right now. And in European side, the European Central Bank, they are on the rate cutting cycle. So this actually makes borrowing quite a fair bit cheaper and therefore easier for businesses to also grow.
We've always been told that defensive sectors do better in volatile times. Things like consumer staples, healthcare, and utilities. Does this mean the defensive sectors of the Chinese market will go through the roof? I'm there.
In China, it's interesting because we have the onshore market, so that it's really the Chinese equity market within China, so companies listed within China. And then you have the offshore market, which is the companies listed in Hong Kong, for example. So they both have exposure to different things. So take, for example, the onshore market. We spoke a little bit about EVs, etc. If that fiscal support that we've been waiting for comes through, then some of the domestic-oriented sectors, so we're talking utilities, consumer staples, this could do really well once that fiscal policy comes through. On the offshore market, so the companies that are listed in Hong Kong, those are more tech-oriented. Insofar as the government really pushes on that line that, we have to be self-sufficient in technology, developing new chips, that would be something that it's worth exploring as well for investors. So opportunities both onshore as well as offshore when it comes to China.
Okay, so we've talked about geographical location as an investment theme. What about the asset classes in China? Which ones won't be too affected by the tariffs? Here's Sean Teo again from Saxo.
Regarding the asset classes, in uncertain times, it's always great to have some sort of diversification in the portfolio. So the diversification is the only free lunch in the world. Before we go on to the asset classes, if investors are actually holding on to any positions that are just not working out, something they can consider is to sell the idea or the stock if it's needed. If the idea is not working out, it's always better to free up your capital instead of tying up your capital and hoping the investment goes your way. Free up the capital and just put it to somewhere where it can further work better. Apart from that, other asset classes that have actually been performing uncorrelated to the equity markets would be gold. So gold has actually been performing pretty well in these times of uncertainty. For year-to-date performance, I think gold has definitely outperformed the S&P 500 and quite a fair bit of number of equities. Also other currencies, so safe haven ones like the Swiss franc and Japanese yen. These two tends to perform better in terms of risk-off and uncertainty. So perhaps maybe not so much of the Japanese yen as of now, because they have been pretty much on a low interest rate cycle for quite some time. But end of the day, if things really go south, the yen would definitely tend to be a currency to look at because they are a very heavily export-driven country. So a lot of countries do import from them. So this is actually a currency which, if countries still don't perform as well, they will still need to do quite a fair bit of imports from Japan itself. Swiss franc, they have a very stable government, and the government has reserves that are also heavily backed by gold. So Swiss itself also tends to be a currency that performs pretty well in times of uncertainty.
Oh, so not just asset classes in China, asset classes in general. Fair enough. So we've talked about whether Chinese markets have been affected by the Trump tariff policy and where the opportunities still are. Let's get into broader economic trends retail investors need to look out for to stay ahead in the Chinese market. More with Raisah Rasid from JP Morgan Asset Management and Sean Teo from Saxo.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Clarissa Montero in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
Welcome back. Retail investors are advised to be diversified in order to weather anything. Wouldn't that mean if we were diversified, we wouldn't really need to do anything, even when things are rocky? Here's Raisah from JP Morgan.
I kind of feel as if it's a two-step approach. The first step for retail investors is really the acceptance stage. Accept that volatility is here to stay. Okay, uncertainty is going to be part of this. The current administration could even be on to the next administration. We've seen some continuity on some parts between the Biden administration and the Trump administration. So accepting volatility is part of the course. Step number two, then how do you really insulate your portfolio against these uncertainties? And this is really about rebalancing. So we're talking about moving away from US and diversifying across international equities, for example. And diversification takes many shape and forms. So one is geographical and it's also across asset classes. It's also across equity styles. So growth and value within the US, if you are into income and you're really interested in that steady income stream, fixed income, And really, in such a volatile time, what you want is a very good diversifying property in terms of an asset class. And that's what fixed income really offers you. So when you get an equity market correction, which we have earlier this year, then that fixed income property of diversifying is going to be there and would actually insulate your portfolio to some extent.
Oh, so still got work to do lah. Oh well, Sean Teo from Saxo agrees. He also has thoughts on broader economic trends in China we should look out for in order to make informed decisions.
For China, right, it's really a lot to do, or at least focus on the Chinese government. The Chinese government is the one that pretty much do what they want at their whim to stimulate the economy or even bring the economy down. But as of now, the Chinese government, they are looking for many ways and actively trying to stimulate the overall Chinese economy. So as long as this remains the narrative for the Chinese economy, I think the economy in China should tend to do well over the longer term.
The two key trends is really on the fiscal front. What will you do to domestic policies? Consumer sentiment hit is very, very painful. It's so difficult to turn that around. So you do need a very strong, very decisive response when it comes to fiscal. I think there's some indication from the Chinese government that they will accelerate fiscal policy. So we're going to see a step up compared to last year, for example. Whether this is going to be more consumer targeted, whether is it subsidies. We've seen that in consumer electronics, for example, furniture, household appliances. We need more. If those come through, then that's positive. And really this technology piece, will China be able to fend for itself if the US tech restriction really come through? Will it be able to develop its own AI landscape independently away from the US? These two trends will be something to look out for. First one on the fiscal, that tend to be more cyclical in nature. So that's what we kind of call the short, medium term. The second trend that we spoke about, which is, artificial intelligence, technology, this is more of a structural basis. If you're a retail investor, you're a long-term investor, number one, timing the market is really, really tricky, especially at this point in time. At the end of the day, you don't want to miss out. If you just think about cash versus any other asset class, right? The only other time that cash has really outperformed any other asset class is really in 2022 when we saw a broad market downturn across fixed income as well as equities. So what we're telling investors, retail investors, to really rotate out of cash and really stay invested in equities. These are structural trends. Again, you're not going to see the returns overnight. These are some of the multi-years, even multi-decade trends that we're talking about, whether it's in the US AI or in Chinese AI.
Given these could be multi-decade trends and that the 145% tariffs Trump imposed in China in April didn't have long-term impact, but then again, how can I say that given it's only mid-May? Plus, they just lowered the tariffs to 30%. The point is, maybe the easing of trade tensions might not have long-lasting repercussions either. Okay, fine, that's all speculation. Basically, in or out for the Chinese market.
In because we do still think that Chinese equities are going to make a very important part of an investor's portfolio as well. We spoke about US exceptionalism many, many times earlier this year, but I think now the rhetoric has changed from US to international equities. But that being said, I think we do need a nice blend of both. We're still in the midst of getting this on negotiations. We've seen Tariff, for example, getting some exemption for China on the consumer electronics side, etc. So we don't know what's going to happen to Tariff post Independence Day in July when the 90-day pause is up.
I would say, in personal opinion, I think it's in the valuations wise for the Chinese markets, I think they are looking a lot cheaper than the US counterpart. So they are looking more positive as compared to like what we are seeing in the US. US is now pretty expensive. In terms of like how the economy is actually growing in China, I think China is pretty decent. Their GDP growth rate are actually still on the positive side. Inflation is still pretty much kept in check and the government are still looking to support the economy. Overall, I would still quite like China at this point in time. Apart from that, other interesting sectors for the Chinese would be the electric vehicles and even AI. The Chinese EVs are starting to become very significant in the overall economy, especially the company BYD. They have been having record high sales for the first time. They actually beat Tesla's sales for one of the quarters. So I think that's one of the sector or at least maybe even a company to actually look out for. So BYD, XPeng, Xiaomi. It could have further potential as the Chinese side continue to grow their EV industry. They are also now trying to further grow their AI sector. US has actually imposed quite a fair bit of tariffs overall, and including the chip sector. So China is not going to just sit by and let this affect them. They are, of course, definitely trying to grow their own chip sector. As of recently, even Xiaomi is actually now looking to produce their own chips to actually compete in this AI space and market. So more interesting things to come for these two industries in China.
Takeaway order Money Hacks 218 is ready. In April, a top Chinese official warned that Trump's tariffs will put pressure on China, but he added they wouldn't stop the world's second biggest economy growing in the long term. Experts say that's an in for retail investors, and who am I to argue? A big thank you to Raisah Rasid, global market strategist at JP Morgan Asset Management, and Sean Teo, trader at Saxo. I'm Howie Lim, and this has been Money Hacks by the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.